Welcome back to another episode of the Anatomy of the Trade. Happy holiday season to everyone, and France to you. Thank you so much for uh, going through almost a whole year with all of these episodes. It was a lot of fun, to go through a lot of charts, a lot of trades, discuss them with you. So I'm looking forward to this session because this is going to be a Q&A session, so something more relaxing for you guys over the holidays to watch and just to contemplate about some of the questions and some of the answers. Hi, Franz.
Hi, Ramon. Yeah, happy holidays to you as well.
All right. So we are collecting some questions from YouTube and from Twitter. So if you guys, have any type of questions that you want to ask us, definitely, leave them under the video, and we'll get to them at certain point. Or you could tweet those, or you could just email those to me at wyckofassociates@gmail.com, and then we'll sort through them and we'll answer them, in the order that we think is appropriate. So the first question is, how are the trend lines constructed? So there are two types of trend lines techniques that we would use. We call them conventional and reverse use of trend lines. And conventional is very simple. You just basically take, let's say, for the uh, um, uptrend trend lines, a low and a low, um, and you connect them and extend that into on the right, and then you look for a significant high between these two significant low points. So it either is going to be somewhere here or this point right here, and you draw a parallel line. So you want to see that this parallel line in the future is going to be acting as a resistance, and it's going to identify overbought, overthrown condition when the price just overcomes it. So this is the condition where we are anticipating some kind of profit taken by institutions. So even in some cases, distributional characteristics, like we've seen here on the way down during the COVID reaction in Apple. So therefore, we are more on the alert. We are looking for some kind of not just the change of conditions, but the change of behavior in the price and volume action. And then final tests to push the price up, failure, and then the move down from the resistance to the support. Franz, what else can we add here for the conventional trend lines?
Um, well, I think you've covered it great. I think it's interesting how price does tend to honor the trend lines, and even from an early point in an uptrend or a downtrend for that matter, it does set the kind of the limits of the price movement for supply and demand until the trend is done. So
Yes, and another point here is, and this is something that I was thinking as Franz was saying this, why would the price honor the trend line? Well, you have to think about a standard deviation, how the price moves around that. So in the trading range, we're basically doing the same as in the uptrend. We're doing something like this. We're just deviating around the mean. In the channel, whether this is a channel to the upside or to the downside, right? So let's say to the upside, we're doing the same thing. Here's the mean, and we're kind of deviating in price, and this is what we're doing. So we're going to have an oversold condition and an overbought condition in both environments, whether this is a consolidation or a trend. And the key for trading strategies for us is very simplistic. Once we have an established trend, then during the oversold condition, we will be buying on the background of the context, which is an upward bias. And then we would be selling around the overbought conditions in the context of the same uptrend. And that's how easy it is. Very simplistic in terms of thinking, but obviously very hard in terms of implementing it. So therefore, the whole dilemma is not just the knowledge. The whole dilemma is just, do you have the emotional capacity to actually execute it exactly the way how it's supposed, to be executed? And then let's come back for a second to the standard deviation. Well, why are we kind of like using this um, as an uh, you know points for us of, or is a belief as to how the price is going to move? Well, because um, usually there is some kind of um, you know a rate of growth for the price action, and if that rate of growth is being exceeded and we go into the overbought condition, professional traders are going to take advantage of this um, uh, mispricing, and they will start shorting as a mean reversion trade, and the price will go down. The same for the oversold condition. So if we're going down and we are in the uptrend, in the oversold condition, the mean reversion traders or the mean reversion systems will try to buy this asset in order for the price to go closer to the mean and then go again into the overbought condition. And it just happens over and over and over again. And it doesn't really matter for the environment, whether it's a trading range or uptrend or a downtrend, that's always going to be like that. Okay, so the second one is the reverse use of trend lines, and we're going to use this next upswing. So for the reverse use of trend lines, what you want to do is you want to identify significant highs, and specifically the first two significant highs. And you kind of could see the difference between the conventional use of trend lines and the reverse use of trend lines. In the conventional, we're taking, let's say, for the uptrend, the lows, and then we're connecting them and we're seeking a significant high in between. For the reverse use of trend lines, that's what exactly it means. A reverse use of conventional trend lines. So we're taking the highs first, connecting them, and we want to kind of see multiple touches here. And then we take the significant low in between this first two highs and just project in a parallel line. And this is our trend channel here. So they are similar, but just the difference in the way of what do you use as your first two initial points for the trend line, the highs or the lows. Franz, what else could we add about the reverse usage of trend lines?
Well, for me, yeah, keeping it straight in a downtrend, it's exactly the opposite. So a reverse use of a trend line in a downtrend would be connecting the lows first and using that as your initial line, and then drawing the parallel line off of a significant high. And a conventional downtrend would be starting with the lows and connecting them first in a downtrend.
Okay, yeah. So
No, I'm sorry, I got that backwards. I'm confusing myself. Starting with the highs in a downtrend, but at any rate, it's just where you draw the first line in the trend.
yeah, and I would definitely suggest a lot to use a linear regression channel. This is the most accurate depiction of the stride of the trend, and also deviations, standard deviations around that mean. So please check this out. There was a question just almost like, a couple of days ago from a student. Do I use linear regression channels? I do, but I don't draw them on in the software. I draw them by hand. So my preference is always kind of like to feel the chart, to feel the price. But you could use the linear regression channel tool, and those are highly, highly recommended. Okay,
Mhm.
one more item here. Um, Whenever you have the reverse use of trend lines, usually you're gonna see some kind of momentum prior to that. So just be aware of that, that you don't have to include this momentum push first, um, and then just use the reverse tr trend lines, once the momentum is done and you have the established initial 3 points for the trend lines. Okay, let's go
And look
to,
how beautifully that worked for Apple, that
yeah,
use of the
mhm,
reverse trend line. Can I ask you one other question?
sure.
Um, you were talking about how you would trade around the mean in an uptrend or a downtrend on a kind of a reversion to the mean basis. Um, do you find that, because what I'm thinking is in an uptrend, rather than taking profits, I just like to use the reversion to the mean to add to a position rather than trying to get you know, too fancy and, try to sell at the top of an uptrend,
Mhm,
counting on a reversion of the mean, which might not come for a while. Does that make sense? See what I'm
mhm,
saying?
mhm. Well, I think that the key here, when we're thinking about the overbought and oversold conditions in France, is that what you're asking? The overbought, oversold
Right.
condition, how we operate around those. Um,
Well, more so during the during the major part of the uptrend itself. Um, Instead of, for me, in an uptrend, it makes a lot of sense on any kind of a reaction to just use that to add rather than to try to, on the rally part to try to maybe, unless it's very, very pronounced and very obvious, to try to scale back, scale out a little bit. I guess you could do that. It depends on how good a trader you are. I'm not that
well,
good. So.
I think it depends on the how the price structure unfolds, how the price moves. I mean, in some instances, you're gonna have such big gaps that are gonna go into the overbought condition, and you know that you're going to go through the consolidation. So, for instance, like this point right here has that supply signature that suggests that we're going to go into a trading range uh, for some time. And for 2 months, you're basically in it. You are not really producing any money during this period of time. So
Mm-hmm.
what you could have done is by recognizing this condition and that supply is coming in and thinking that the trading range is going to unfold, you could scale out and then come in at the time when uh, the price is ready to go up. Here, I don't see a lot of supply coming in, so maybe I'm not, scaling out there. And then here, I'm seeing an overbought condition, and I see how the volume is starting to come in, some selling starting to come in, especially right here. So you want to scale out more right there. So
Mm-hmm.
it just depends on how the price moves, depends on the momentum of the stock. But trend lines are extremely useful. So absolutely use them, to determine not just the bias itself, but also determine where professionals are doing the mean reversion trades at which spots. All right, so let's go to the second question. We're going to use the same chart. And the second question is, what technical indicators do you use besides price and volume? Well, actually, I use four primary data points: price, volume, time, and sentiment. And someone might say, well, how do you use sentiment? Um, well, we get the sentiment uh, data from the chart itself. We understand the behavioral implications that the chart shows us. So therefore, we understand the sentiment of the institutions and sentiment of the, let's say, weekends. So let's just repeat this: price, volume, time, and sentiment. So these are the four that are extremely important as the primary data. Everything else is secondary. So any other indicator that you're going to use is just a depiction of what you already see on the chart. So to me personally, I do not use a lot of indicators. I used quite a lot of indicators before. Then I just went into the mode where the price, volume, time uh, were the uh, were the only data points that I was looking for. And then I started seeing in the price and volume and how time unfolded there, and sentiment as well, certain patterns that we are looking for in the indicators. So, for instance, you could see the momentum in the price. You could see the outperformance and underperformance in the price action. You could see accumulation and distributional characteristics in the volume and price signatures. So then the question, you could see the trends, you could see the oversold, overbought conditions, and so on and so forth. So then it becomes kind of an interesting question. Do you really need those indicators? If you could see and if you could extract everything from the price, volume, time, and sentiment data. So therefore, there was no need for me to use indicators anymore. Now, the one that I consistently show to our students is the relative strength ratio line. I think it's an easier visualization of strength, and specifically the trending characteristics of that outperformance or underperformance. Because you could do a comparative analysis. So there are two ways of how we could compare one asset to another: comparative analysis and then relative strength analysis. And those are somewhat similar, but there is a distinction here. In the comparative analysis, we would be picking the lows, significant lows and significant highs, and compare them by synchronizing it with, let's say, a market proxy. With the relative strength, you could do the same, but you also have an advantage of looking at the relative strength trend. Is it trending up? Is it trending down? Is it breaking a trend or not? So relative strength as a kind of like a trending tool for outperformance and underperformance is extremely helpful. I would just use that. And then in terms of other indicators that, let's say, I would use, obviously, moving average is a very helpful trending tool. You could use that. It would act kind of the same as trend channels, trend lines that would identify spots in the trend that are oversold. You could have shorter moving averages that are going to show you places of the short-term oversold conditions, short-term overbought conditions, and so on and so forth. So very useful trending tool. And I have also a rate of change and on-balance volume. So let's talk about them in a second. And Franz, let me ask you this question. What about you? Do you use any technical indicators on your charts besides, the primary data of price, volume, time, and sentiment?
Okay, I basically use price and volume, and a lot of what you're going over here is information that you share. This is just a little commercial here. Information that you share in your teaching in your WTC1 and WTC2 courses, and I keep coming back to WTC2 because the information that you have gathered from your years of study, you impart, very generously share with your students, and I'm just trying to lean on you and learn as we go.
All right. Okay, let's go to the next question. Are there any technical indicators that can help identify institutional accumulation and distribution? So you could definitely use quite a lot of the indicators to show you what's going on with institutional perception of where we are. I've mentioned the relative strength. So relative strength is a very unique institutional tool because it's used universally by institutions. They basically base their models in a lot of cases on the relative strength performance and price performance. So absolute price performance and relative performance by the stock. And they want to synchronize that performance. So meaning that if the price is going up and let's say breaking out and the relative strength is improving and breaking out as well, they will get on the position. So we see this increase in the volume signature as an indication that they are getting into this position before the actual move up. So you could use this technique. But there are tons and tons of other technical indicators that could identify institutional accumulation or distribution. So you just have to kind of like pick them on your own, and decide whether it works for you or not. My cautionary note here is do not use a lot of indicators that show you the same thing. For instance, if you're using a rate of change, there is no need to use RSI, MACD, and so on and so forth. Those are all momentum-driven indicators. I mean, you can, for maybe different reasons, maybe different time frames. Sometimes I would have the rate of change where I have the short-term rate of change, intermediate rate of change, long-term rate of change, and then the relationship between those kind of indicative of certain price conditions. Specifically with the rate of change, why would we use the rate of change? So the rate of change shows how quickly the price moves in one direction or another. And usually it's those kind of like quick moving places, those are of interest to me. And obviously when they come out of a specific, conditions here, like an oversold condition. So I would be looking at those as the areas where institutions are coming in and trying to establish a position, and that moves the price. So you could understand the momentum that way through the accumulation by the institutions and the price movement that accumulation creates. So that would be the translation into the accumulation or distributional characteristics. You could also look at the unbalanced volume, which is also a very helpful tool to identify the presence of institutional presence. Usually retail traders cannot create a sizable volume signature, but institutions definitely do. And we could see how, let's say, this volume spike right here shows a lot of deterioration in the cumulative volume signature on balanced volume and suggests that institutions are heavily selling. And then going forward, look at how there is this improvement right now in the unbalanced volume line, and it just suggests that they are buying. And looking at the price, we see that the price is going up, extending up. So therefore, we are thinking that our bias is going to be to the upside and that we are in the period of some kind of accumulation. So these are the primary tools that I would suggest for you to use: unbalanced volume, relative strength ratio line as a must, and something on the momentum like a rate of change. Franz, what else could we add to this?
Well, I think you've covered it very well. And for me, it's really trying to use the price and volume activity itself and get that, extract from the chart all of the information from that without getting too confused with other indicators. So that's kind of my approach.
All right, great. Well, guys, thank you so much. This is the Q&A session number 1. So during the holiday season, again, we're just gonna have Q&A sessions. So if you have some questions, leave them under the video and we'll collect those. We will not answer them right away. I would rather go to some trades and analyze those. This is the primary kind of like functionality for the Anatomy of the Trade series. But we'll gladly cover some of the questions maybe in the future, and we'll have just one more episode next week on that. So check that out. Franz, thank you so much.
Thank you, Ramon.